Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have James McCann, Deputy Chief Economist at Aberdeen, James Ragan, Director of Wealth Management at D.A. Davidson, and Douglas Evans, CIO of Callan Family Office. We're here to discuss the macro impacts to the market following everything that's going on within the space, from the Fed cutting interest rates to elections to what's going on geopolitically. Gentlemen, it's great to have you with us. It certainly has, there's been a lot of news that's taken place over the past, few months, to say the least. James McCann, let's start with you. What about your reaction to the 50 basis point rate cut? And what do you think that signals for monetary policy going forward?
Yes, well, a strong cut, as Chair Powell put it. And I think it shows a central bank that's really fighting to be ahead of the curve. They want to be proactive and they want to ease those market fears that they maybe were slipping a little bit behind things. Now, I think we can take a couple of important points from the decision to go 50 instead of 25. The first is their reaction function just looks more dovish than I think we and maybe the market had anticipated, to this sense that they may be even more sensitive to weakness in the labor market and perhaps more confident that some of the inflation risks are starting to dissipate. That points towards looser policy. And then the second is they've broken the taboo of 50 already. So they're clearly prepared to go in big increments if needed. They've been very clear that they don't intend to every time, but it implies to us that there's a lower bar to that. So I think it's encouraging from a market perspective that you've got a central bank looking to be very proactive in easing policy. And really, I think that gives the soft landing narrative the best chance that it's got. They just need now the data to cooperate with them.
Right. And James Ragan, when you take a look at the dot plots, what does that suggest for Fed policy longer term?
Yeah, and so they're saying another 50 basis points between now and the end of the year, and another 100 basis points for next year. So that part of it was, relatively in line with what was expected going into the meeting. I think it was the 50 basis points to start it off, and I agree with James that gives them a little bit more flexibility. I think that, but if we're looking at a Fed policy that's really a mid-cycle adjustment that allows them to gradually reduce rates over time, the 50 basis points is a little bit more than you would expect. So I also agree that shows some concern maybe with the employment data, and that, so I wouldn't rule out the possibility of more than 50 basis points between now and the end of 2024, depending on how some of the employment data comes in over the next couple of months.
Doug, you made an interesting note here that these rate cuts are going to have far-reaching effects, but they're going to be uneven. Tell us what you mean about that as it relates to certain areas, whether it's near-term or long-term.
Yeah, no, there's clearly a tidal movement in rates now. The Fed has joined a chorus of other central banks around the world, and we're now past the 50-yard mark, in the sense that you now have more than 50% of all the central banks around the world in an easing cycle. So the world central banks are now officially in an accommodative stance. I think that's going to create a couple different things. You're going to see some knock-on effects clearly near term for all the variable rate borrowers, so people who have variable rate financing, which I think you see both in the business as well as personal space. And you're going to see immediate near-term relief, and that will help. And I think that puts some cash back in people's pockets. That's going to be number one. But longer term, I do think you're going to have some impact about where refinancings take place and what that leveling is going to look like. A good amount of the world locked up some pretty meaningful debt between the years, call it pre-pandemic, maybe 2014 through 2019. You have a lot of low rate, longer term debt, and some of that's going to be coming up for maturity and renewal. So in a lower rate environment, that's obviously going to be a bit more accommodative. Certain projects will start to pencil in that environment, as opposed to maybe having to face a steeper interest rate climb. So you're clearly going to see some impacts on borrowers. You're going to see some impact on cash flows, and you're also going to see a difference on how people look at some of the major currencies, including the dollar. So my guess is that, yes, you'll see a ripple effect, and typically rate cuts it will have something that land on shore today and those that take some time, but you will see this roll out a positive stimulative effect over the next 12 to 18 months.
Doug, let's talk about this as it relates to the consumer and the housing market, because those have been two important things to this economy. We know that the consumer is 70% of the economy. Is that going to be enough in terms of moving the needle for opening up supply in the housing market? Because to your point earlier, there's a lot of people who locked in mortgages and other lending, sub 4.5%. There's a lot of mortgages out there where it might even make sense to move unless you have to, right?
Yeah, I mean, clearly for those who benefit from long-term fixed rate mortgages, I'm not looking to see any of that really be released. I think that inventory is probably going to stay in place for quite some time, as long as it's being as well compensated as it is today. But I do think that if you look at where both mortgage applications and housing starts have been over the last, really 6 to 12 months, it's gotten down to something of an anemic level, while at the same time, household formation demand continues to go up. So you do have this pent-up demand, and there are people that would like to buy a home that frankly just can't afford it. I think you have two things that are at work here. First, you do have the absolute level of rates as impacted from the Fed curve or from the Treasury curve, but you also see the spread related to that rate. And I do think you're seeing a bit of compression in the spread in certain parts of the curve, and I think that's going to help incentivize home buyers. But at the end of the day, we're probably going to build from a pretty low base, and you do see falling rates being a stimulative effect there.
Yeah. And James McCann, let's turn to the election. We know that's the next event on the horizon that not only will we have all eyes on here, but that's going to have a global impact, right? Do you think that volatility has started to insert itself into the market at any point? It doesn't feel as if markets are that nervous yet.
Well, I think you're right. We don't see a huge amount of volatility on this issue. You could argue, I think there was that period after the first presidential debate where it really looked like Republicans were on course potentially for a clean sweep. And maybe you started to see some trades priced in that factored in some of that policy agenda we think could follow. But really now it looks like a toss-up. Our best reading of the poll is that it's highly uncertain. And I think the markets are watching it closely and trying to get to grips with what still is an evolving policy platform. We've still got new policies coming out from both candidates. So my suspicion is as we increasingly get up to the eve of the election, markets will be more and more focused on this. But the difficulty for them is calling what the outcome will be, what the candidate will win the House, which candidate will win the White House, and then what congressional makeup they will face. And it just adds to uncertainty. So I think volatility is probably a word that we will be coming back to as we think about that issue going into 2025.
And James Ragan, when we think about it through the investor lens, there's so many headlines, right? It's overwhelming to investors. Do you recommend that they make any moves around this or just stay the course?
I mean, we're staying the course, but I'll make a couple comments about that. I mean, historically, the data really shows that it's not prudent to make large portfolio changes based on the outcome of the election. And even when you look at, historical data, when there is a clean sweep, either a blue sweep or a red sweep, even in recent data, both with the Trump administration and the Biden administration, both came in when their parties swept, you had the markets doing pretty well the year after that. We always hear the adage that investors like, divided government, but I think there's been many times when even a clean sweep government has been good for the market. So I think we have to resist trying to make predictions, especially now. I haven't seen, so much uncertainty, so much a toss-up, not just for the presidency, but the House and the Senate as well going into the election. So we want to stand back, but then also, not making big portfolio changes to us also means we don't really see equities, necessarily going off to the races here. I know we've made new highs here in recent days, but we cautioned that we don't think we're going to really take off here. We would expect a little bit more volatility over the next 5 weeks or so leading into the election, and I think investors should be ready for that.
Right. Doug, another potential catalyst, however, could be there's a lot of cash on the sidelines, right? And as we see those interest rates come down and investors look to put their money elsewhere outside of, higher rate money market accounts, there's a lot of money that's sitting out there.
That's right. I mean, we're at record levels, over $6 trillion in cash sitting idle. And it's right. There is an alternative, right? We ended the era of Tina a few years ago, but all of a sudden now maybe we're going to head back to it. But that cash, will have a propensity to find ways to get put to work as the rewards for being in cash come down, whether it's going to be other parts of the fixed income market or frankly, a whole nother other asset classes is yet to be determined. I do think that there can be a real positive offset with that, and that what we would like to see is the markets continue to broaden. Leadership in the market's been so narrow. It's nice that since the early July peaks in the Mag 7, you've seen other parts of the markets really rally since that time. We're hoping that trend continues. It would be a a very pleasant sort of unwinding of a pretty meaningful concentration in the market, and cash can be a real active agent in that equation. So if this leads to broadening of markets and cash being put to work in what we would consider sort of appropriately or attractively priced asset classes, I think that could really help the economy.
Yeah, and James Ragan, you had made a similar point as well. I mean, you have to think about it. If we did not have that AI/innovation theme since the end of 2022 in the markets, I mean, would we potentially beat these levels right now? So I think it is encouraging to see that this is broadening out more and we don't have that concentration risk in just a handful of stocks or one subsector.
Yeah, I think it's very encouraging. I mean, the rotation, as you can go back to the end of June, so the whole of third quarter, which ends in about a week here now. We've seen leadership from utilities, the REITs and financials, and they've done this and taken the market to new highs, while the S&P 500 technology sector, I think as of Friday, was still down fractionally for the quarter to date. So, I think a little surprising to many that the technology stocks could pull back and we could still see the market at new highs. And if that continues, that's a positive development in our view. And we've seen, we attribute the gains we've seen to sectors that are interest rate sensitive, and also, a little bit more on the value spectrum or away from growth. We get a lot of questions these days about, should we become more cyclical or defensive in our portfolios? And I think the readout there is a little less definitive so far in the third quarter. We've seen some cyclical sectors like the financials do very well, but energy is down on the quarter. And so, if the economy is really, again, in the mid-cycle and it is going to continue to grow here, you'd expect the cyclical sectors to do a little bit better. So while we still think the soft landing is in place for now, I think that the focusing a little bit more on the defensive names is probably not a bad idea. So we are urging investors to maybe add a little bit of defensive exposure in here. Earnings growth still looks pretty solid. It's been better than expected this year. And it's really picking up for some of the non-tech sectors, but to us, the estimates for 2025 still seem a little aggressive.
Right. And James McCann, your thoughts here, or perhaps other asset classes that you could also take a look at?
Yeah, I mean, I think we'd echo some of the messages on equities. We still like to hold equities. We think that's consistent with a soft landing in terms of our house view. Thinking a little bit more broadly, I think there's a few other interesting asset classes. We quite like EMD at the moment. This trend towards lower, US interest rates and a weaker dollar potentially supports that, particularly in the local currency space. We find that quite attractive. Have to be selective on the market, of course. And then we think within credit markets, investment grade still looks attractive to us over high yield, just based on valuations. And we think maybe there's a bit more scope for duration to run as well. And that gives you a little extra kicker on the investment grade side versus the high yield. The comment earlier about that refinancing clip were interesting. We do still think for some high yield companies, those step ups in interest rates, even as borrowing rates have come down a little bit, there will be a meaningful step up there. So we're mindful of that refinancing issue potentially for some high yield companies, and we think the better quality companies look a better bet at current valuations.
Yeah, and James, you had mentioned emerging market debt, and that's a theme that we've heard as of late on the show. What's attractive about it? Is it specific regions that look like they're set up for growth, or is it purely a valuation play?
Well, I think it's a combination. I think from a global perspective, this trend towards lower US interest rates should provide additional policy room. When we look at real interest rates across a wide range of emerging markets, we think they're relatively high. So we think there is scope for emerging markets to follow the Fed and for a broadening in that interest rate easing cycle. We obviously have to be careful. There have been one or two big high-profile names which are going in the other direction. So Brazil being a useful example. India domestic growth is very, very strong. So maybe the relative rate differential not moving as much in the favor. But if we look at economies, particularly lower yielders in Asia, certainly we're seeing a degree of pressure come off as US interest rates start to fall. And we think that's a healthy tailwind for a region that has lived, I'd say, if we think over the last two years or so, has lived with higher US rates and higher domestic rates, probably better than we might have hoped or at least feared. So I think there's a few reasons to be quite positive on that. But underlying it all, I think, is that helpful sort of weaker dollar tailwind, lower US interest rate tailwind.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.